The US dollar has declined pretty substantially versus other major currencies in response to President Trump's tariff policies. So could this dollar slide continue? And if so, what does it mean for your money? Let's start with why the dollar has actually declined. So coming into this year, most big global investors were overweight US assets. And there were reasons why there was relative optimism about the US. The thought the US had been growing faster than most of the rest of the world for the better part of a decade. You had particular concerns about energy prices in Europe, about various issues in China, rising interest rates in Japan that had global investors a little worried about those places. The US was having hopefully some tailwinds from tax cuts and maybe deregulation by the Trump administration. And then lastly, the US was the center of the whole artificial intelligence trade. And so if you believe that AI was going to be a big part of the future, the US was the place to be. But then as the year started to progress, we learned that President Trump's tariff plans were going to be more severe than what was assumed. This caused these global investors to completely rethink the outlook for the U.S. economy. So instead of the U.S. seeming to be the faster growing country, all of a sudden it seemed like maybe there was going to be a U.S.-centric slowdown. So if you imagine that you start out way overweight U.S. assets, according to one Bank of America survey, they were as overweight as they've ever been, more or less. And then all of a sudden you're like, well, the outlook has totally changed. You probably need to change your allocation. So what we saw over the course of the first quarter was a really dramatic change in these global allocations. Again, according to a well-followed Bank of America survey, there was about a 40 percentage point swing from about a 20% overweight to about a 20% underweight by these big global funds. Mechanically, as you are moving money out of the US, whether it's in stocks or bonds or what have you, and buying assets elsewhere, you're also selling dollars and buying that other currency. So for example, if you sold Microsoft stock and you bought Nestle stock, you're also going to be selling dollars and buying Swiss francs in order to buy that Nestle stock. And so as we were seeing this dramatic shift in allocation, that is really what was driving the dollar lower. Now, I warn you to be aware of double counting. So, I've heard people say things like, boy, the U.S. Recession risk is on the rise, and it looks like global investors are abandoning the dollar. That's not the right way to think about it. The right way to think about it is, yes, there is an increase in U.S. recession risk, and that's an important thing that investors need to consider, but that's why the dollar has declined. So that's not like an additional thing you need to think about. Those things are actually one thing. Now, one story that's out there that I don't think is the case is this idea that maybe governments are dumping dollars, particularly here about China, maybe Japan, etc. So when governments own dollars, what they really own are treasury bonds. And in particular, they tend to own shorter term treasury bonds. So here we're talking about foreign currency reserves, which is where governments will own dollars and potentially other currencies in order to manage the value of their own currency. Or we're talking about central banks. So that's like the Fed equivalent in other countries. And in all those cases, if they quote unquote own dollars, they're actually investing in treasuries. But as I say, they keep it more short term. The goal is not to take a lot of price risk and see a lot of volatility, which you tend to get with longer term treasuries. And so if these kinds of accounts were the ones who were aggressively selling treasuries and thus causing the dollar to decline, what you'd see is the worst performing part of the US Treasury market would be those shorter term bonds. In fact, you saw exactly the opposite. You actually saw all of the volatility really, really focused in very long-term bonds, which just aren't the kinds that governments tend to own. Specifically, who owns long-term bonds? Well, the answer is big global pension funds and insurance companies. And so it gets back to our original story, right? That it was these private accounts that were probably the ones who were selling assets. It fits both what was going on in stocks, what was going on in currencies, and what was going on in the bond market. Now, when people are asking me about a decline in the dollar, a lot of times they're really asking, could the dollar kind of collapse and no longer have this special place in global finance. Look, the reality is that position the dollar has both in global trade and in foreign currency accounts and what have you is not that fragile. There's actually many, many reasons why the dollar is the most convenient currency to use in those kinds of situations. And only that most of them haven't changed just because of this sort of tariff policy. So I'll name a few of these big reasons. One is that the U.S. is just by far the deepest and the most varied financial market in the world. So that means if you're a big global manufacturer and you need to sell bonds in order to finance your activities, you probably don't have a big enough home market to do that. Like there's just probably not enough investors in your home market to finance what it is you need to do. Whereas in the US, there is a huge investor base that can accommodate the kind of size that you need. Moreover, if you need to do something like hedge various prices, which most big global agricultural companies, metals, energy, etc., have a real need to do, the US is where there's by far the best markets to do that. And so if you're a Brazilian soybean producer, there's nowhere in Brazil you can hedge the soybean price like you can in the US. And so because you're doing your hedging in the US, it's convenient that you're doing your trading in dollars, because that way there's not also a foreign currency component to your trade invoicing. The last thing I'll point out is that the U.S. banking system is also a convenient place to store your money. Not only is the U.S. wide open and you can move money across borders very easily, unlike a country like China that's very strict capital controls. It's also true that it's very easy to open US dollar accounts in foreign banks, which is not always as easy to do in other currencies. And so these are all reasons that really are just convenience reasons why the US is kind of the preferred currency to use by a lot of these big global players. And I don't see that changing overnight. Now, that being said, doesn't mean that the dollar can't keep declining. So if we figure that the reason why the dollar has declined so far is that the U.S. economic outlook has weakened by some degree, well, that it could keep weakening. That's certainly possible. And if so, I would guess that the dollar declines. Another thing that could happen is that the Federal Reserve could start cutting interest rates. And typically, if interest rates are falling more rapidly in one country versus others, this country tends to see their currency weaken. And so those are both reasons kind of why I could certainly see the dollar decline. But if you're invested globally already, let's bear in mind that you already probably have a lot of your assets in non-dollars already. So at Facet, we have about 30% of our equity portfolios in non-US investments. And so that functionally means that 30% of your portfolio is not in dollars. And if these things happen, like the US outlook weakens or the Fed starts cutting interest rates, then that might be something of a hedge, right? So those global investments may have something going for them, i.e. the dollar weakening in those kind of cases. And so as an investor, that makes me happy, because I know that I may lose money in my main portfolio due to recession. It'd be nice to have something that might be going a little bit better in that case. But I'm not sure that most investors need to worry about currencies beyond that. So if you're like most Americans, all your income is in dollars, all your expenses in dollars. And so in that case, it doesn't really matter very much what happens to the dollar. So even if the dollar were to decline by another 10%, I doubt you would notice it in your day-to-day life, unless maybe you're planning a vacation to Europe. But otherwise, it doesn't kind of impact you very much. And so I think a lot of times when people are thinking about, man, I need to hedge their currency, they haven't thought through why that might matter to you. It probably doesn't. So look, it's definitely true that recession risk has increased here in the US, and that matters for how we think about investments. But let's not also tack on the risk associated with the currency. So I'm glad that I have a little bit of that currency hedge in my global positions, but I don't need to think about currencies too much beyond that. But hey, what do you think? Do you think there are some risks to the US position in the global market that I'm not talking about? put a comment in the comments section. I'm happy to respond to anything I see there. If you like this content, we're going to be coming at you something like once a week with what's going on in markets, coming out of the Fed, coming out of the White House, etc. So hit that subscribe button. You'll be the first to know when we have a new video. I'd love to see you again.